So, Patrick, it's been a couple of weeks since we've gotten together and talked markets, and looks like we missed a couple of important weeks to take a vacation on.
You know what? I have learned now over the last, let's say, 5-6 years that it's actually a really bad idea to vacation in August. I think I'm going to start vacationing in July and always be trading in August. Like, I don't know. It's a long tradition to always take off the last 2 weeks of August, and it's stupid. It's just so
it's interesting you say that. Scott from Volatility Wiz, I can't remember. We're going to get him on the show. He actually messaged me about this very same thing. He said, "Why does everyone take the last couple of weeks of August off? Often it's the best ones to trade." And I said, "I don't know, but I'm too busy, on vacation to think about it." And then.
Well, it's good that we're back here for an update, man. But what's your thinking?
Okay. I know you wanted to talk about stock market or the US dollar.
But how about the 10-year yield?
I think that's what we have to talk about. And first of all, I have to give a big kudos to you that I have been so wrong. It's not even funny. This the 10-year yield. Let's just think about this. In May, or when was it? Let's just look at the beginning of the year. The beginning of the year, it was 260.
We started off in October up at 3.25, let's say.
Yeah,
and
but
and
listen,
the start of the year was 275.
Right. I was never I remember that was the Jeff Gundlach 2 closes below, past 3.25. And if you remember correctly, I was fading that and saying that, even though I'm a bond bearer, I feel like that this is the stupidest thing in the world. You got to be going the other way. You got to be buying them here. But I then proceeded to turn bearish way, way, way too early. Just no doubt about it. And it's amazing to me that I saw a stat the other day that the government bond index had its best return since the great financial crash.
Wow.
Or crisis. I called it a crash, but it's probably a crisis. So now, let's just stop and think about this. The great financial crisis, the world was ending. People were worried they weren't going to be able to be, the banks were going to foreclose on their houses. That's if the banks were people were worried that there would be no money in it. It was a disaster. Okay.
Right.
Let's think about what we've experienced today. Unemployment still kind of terrific. No real issues there.
3.7 or something.
Yeah. The stock market within 3-4% of the all-time highs.
Yeah.
And yet there is a complete and utter bubble in fear assets. It's shocking to me. It's actually
bonds went parabolic.
Yeah, and good for the bond bulls. No doubt about it. You guys nailed it, and it's been a great trade.
The last leg, I was on the sideline.
But listen, that's Patrick,
all the big picture trading members and myself were selling the TLT around the 140 level. So
you still got a big, huge chunk of it, and the reality is you're not an idiot like me trying to fight this thing. I though find it amusing that people aren't willing to call this a bubble.
Okay. Where I push back on you is that the rest of the world is in negative interest rates.
So first of all, I am calling it a global. I am calling it a global bond bubble.
Yeah. Okay. That I'll agree with.
Not a U.S. bubble, because relative, they're cheap. I get it. I understand why you'd want to buy it. I get it. If central banks throughout the world continue to try to throw monetary solutions at every single slowdown, then the U.S. is going to zero, and it's going to be a great trade. So I completely buy that. But how people – listen, Patrick, 1 second. Yeah. That there's pension plans in Europe that are actually up 30% this year? Because they own these bonds. They're along the bonds.
Dude, the German 10-year hit minus 70. What is it? Okay. What was the low? Hold on. The low was minus
74.
What? Holy
cow. So let's just stop and think about what a bubble is. A bubble is buying an asset that can't make any money with the hopes of selling it to somebody else, like greater fool. At an even higher price.
Yeah.
By its very definition, bonds at these stupid negative rates are a bubble.
Yes.
There's no way you're going to make money in this bond market unless you sell it to somebody at you sell it as it goes even more negative in terms of rates.
So that is,
so
of course, that's because you delusionally continue to believe in free markets and that there's real risk management decisions being made here. I mean, when you go back to my financial repression narrative, it's just a massive suppression of interest rates that's being manipulated. It's not free markets.
Listen, I'm not disagreeing with you. I understand why.
But then, how could it be a bubble then?
Because not only listen, Patrick, I'm going to push back on this. It is a complete bubble. Everyone on Twitter is long out the hoop. It is one of the most crowded, crazy trades that I've ever seen. It reflects the mania of kind of the .com bubble, in my opinion.
Right.
And listen, it's working. It's you guys have great. It's continued to work. It's a great trade. Everyone that's bought bonds is up all sorts of money. Great, good for them. I've been wrong. I'm not going to deny it. But I will say the fact that everyone is telling me what an idiot I am and how this is such a great trade and how it's only going lower, and that's the very definition of a bubble. Because people think that somehow that if that the bubbles are created and that the majority of the people are going to see them. And I call bullshit on that. Everyone seems to think, oh, you know what? The real estate bubble was so easy to see. The .com bubble was so easy to see. Bullshit. No, really, honestly, I was in both of those, and everybody was long. Not now. Obviously, you're going to give me some examples. You're going to give me Kyle Bass was short, Paulson was short, or there was some guys in the thing. But the reality is that those were the exceptions, and the reasons we know about them now is because they made so much money going against the crowd. But if it was easy, to be on the other side of those trades, then why didn't everyone do it?
Yeah.
If it was such an easy, and if it wasn't a bubble, then why didn't everyone do it? And I contend that we are in the midst of the greatest, the third bubble of my lifetime, which is the sovereign debt bubble. And I think that negative rates are by its very definition insanity, and the fact that we can't see that the Germans and all of Europe rushing out to buy U.S. bonds is creating this environment of this bubble.
Was it Raul, Paul, that was showing his little graph where he was talking about -4?
Yeah. So I would, my new line is,
we have to talk to him about this, don't we?
Well, yeah. Well, we should talk to Raul about this, but he's there are bond bulls and then there are rules, because he is just in another, I've now kind of prefaced it as saying that guy is Raul Paul bond bullish, because that's how he's just in another league. And listen, good for him, man. He's been bullish this whole time and he's been making a ton of money. And I'm not trying to.
I liked his original call where he was saying we're going down to 50 basis points on the 10-year. But the idea of seeing -4% on some of these Europeans, it's like.
No, he said -4 on the U.S.
What?
Yeah, that was one of his latest tweets. He went.
Was
and
it
put
the
U.S.
US one?
Yeah, no. He recently he just did one of these. Anyways.
Yeah.
Doesn't matter.
I will take. We should find out, because it's going to be interesting.
I just think that we're going to look back at this time and we are going to laugh that we thought we couldn't make inflation. I really think, you know what, this is immortalized. You know what, for those who are listening, they can go dig this up in 2025 or whatever and go, look, you were an idiot. 1.5% on the 10-year was a great buy because it's -4 now. And then you can play it for me in 2025. But if I'm wrong, I'm wrong. But I look from a risk-reward perspective. This is one of the most crowded trades and one of the most lopsided trades I've ever seen.
So one thing that we've been doing podcasts together for on and off between different things for a couple of years, and I've gotten to know you pretty well. The one thing I can tell you about you is that you just cannot, when you're in a bubble, the most valuable thing is to ride the bubble and just know when to get off the train.
Oh, completely. Listen, George Soros said that. He said
you can't
Yeah,
You can't ride a bubble. You're like the ultimate contrarian.
I completely agree.
The moment everyone likes something, you hate it.
Yeah.
I think what you need to do is just relax a little bit and say, I'm going to go for a little ride. If these guys want to take this market a little farther, I'll clip something out of it. Like you seem to like be obsessed with just calling everyone crazy.
Oh no, I'm not calling you crazy.
Oh, you're calling everyone crazy.
No, I'm saying that we're in a bubble.
Bonds.
I'm saying we're in a bubble, and then I think the risk reward. Now, Patrick, I will talk to you about what I think is super interesting about this market.
All right, okay, tell me.
If you go look at who's long and who's short,
right?
There's very few people that'll come out and say I'm short bonds. Like apart from like I'm an idiot, and I'll admit that right now I'm short, and I've been like taking stabs at it, and I get like roasted on Twitter all the time about it. But the reality is I'll admit it. But most people won't admit it. Most people won't say it's a bubble, right? Like most people are too scared to say it's a bubble. Yeah. I'm going to say it's a bubble. I think it's got all the bubble characteristics. I think that it's by the fact that we're negative and we're not calling it a bubble is crazy. But anyways, but I look at who's short, and I look at I kind of look at the big accounts. PIMCO is actually underperformed by like 300-400 basis points in their big account. So what that means is they're short.
Or they just shorten their duration.
Yeah, so they're short their duration, but the reality is that for all intents and purposes, that's behaving like a short to them because they're underperforming their peers by their benchmark. So they might as well be short because the pain there is huge. Okay.
Yeah.
Then who else had a bad kind of year to date? I'll give you a hint. He was recently at the Burning Man.
Dalio?
Yeah. Bridgewater's down like 6 or 7% this year.
Really?
So I ask you, like with the stock
I think he's just going too much Burning Man.
Yeah, he burned a little too much at the Burning Man. But the reality is that they also and to think about it, stock market's up. How are they actually down on the day? They got to be net short bonds.
Yeah, probably.
Right? So they're down.
But I mean, aren't they doing like one of their all-weather strategies, or do they have like a...
No, but Patrick, they're down 6%. What's the stock market on this year to date? It's up.
It's up, yeah.
Gold's up. Bonds. So the only
the only way is that they were short bonds.
Yeah.
That's fair enough.
Okay,
yeah.
so that's it. Then you go.
But they weren't they like short European equity as well?
Yeah, but they might have been, but Patrick, I'm pretty sure they're short bonds. But anyways, the next thing, Guggenheim, big firm. That guy, like Scott Minerd's basically been talking about he's short as well, whether he's outright short or just like leaning that. So I look at it and I think this is kind of a very interesting setup. We have retail, fast money. Hedge fund managers, everybody out the wazoo long. The big, huge, long-term money is short. Now, maybe you'll say,
squeezed.
Yeah, maybe you're going to say, okay, PIMCO's not going to be able to stand the pain. They're going to cover it. Maybe Bridgewater's going to cover it. I don't know. I'm on the other side. I think there's a disaster.
Of course you're on the other side. Of course you're on the other side, dude.
I'd rather be with...
Our listeners would be disappointed if you said anything different. You realize
that's right. That's right. I think even though Ray Dalio is experimenting with all sorts of hallucinogenic drugs at Burning Man. No, I'm just kidding. He's not. I don't know if he is or not. If anyone was there and can confirm that or not. Or maybe there's another tent I've heard about.
Ray, if you're listening, what? I've never been.
Ray is not listening. Don't even kid yourself. Like, don't even joke. Do you know that there's another? Have you ever been to Burning Man?
Never.
No, I'm pretty sure. No, I haven't, but I've heard stories. I'm pretty sure there's a tent where you might. It's like a key party. Let's just say it's like that. So maybe he's just thinks he's got to spice things up a little bit, and he's gone to that tent. Anyways, regardless, I look at it. I would rather be on PIMCO, Ray Dalio, and Scott Minerd's. I don't know how to say his last name. I'd rather be on his side of the trade than all of these guys that are reaching for the bonds, telling me that it's going to go to zero and that they're going to the Fed's going to peg the curve at
zero. So you've only talked government. What if what do you think will happen to things like investment grade corps in the U.S.?
I think they're fine. I think that the
What?
spreads might wide. No,
Oh,
like
just
no, the spread versus the governments.
not spread. Forget it. I'm talking about look at the run on this chart.
Ah, yeah, but
Like,
it doesn't
they
matter.
have
Like,
been-
like I so if
But I
spreads
mean,
stay
look,
the same,
so-
but if the
so-
spreads
so
stay
if
the
the-
same, Patrick, then I just don't think it matters. Whether you're short, if spreads stay constant, it doesn't matter if you're short investment grades or if you're short governments. It's going to be the same trade. It only matters if spreads change. And all I'm saying is I don't really have a view on spreads. And in
Right.
fact, if I had to guess, I would probably guess that maybe spreads even might tighten going forward.
Tighten.
Even that sounds stupid, I know, but like
Yeah,
I
but
just
I mean,
think
I'm
I think there's a
surprised.
lot
I-
of fear. I think there's a lot of fear in the market right now. And
See, I wouldn't
suspect
have
that-
I wouldn't have the kahunas to say that. Like I look, you know what? I think that they could stay flat, but for them to narrow is a different call.
Yeah, listen, I'm not trying to say that I go out long like credit spreads. I would never do that trade. I'm just saying that if all else being equal, if we get a situation where the market actually goes into a real sell-off, I could see a situation where corporates do a little bit better. It is interesting that the amount of supply that came on Monday when we got back, or Tuesday when we got back after Labor Day from the investment grade credits is huge.
Right.
Like there was like 29 issues or $29 billion of issues. I can't remember, but it was a big number. But it was like across the board, a lot of different sellers. Apple doing a 30-year. I like their style because they're going out and selling the long end of the curve.
Right.
It makes a lot of sense, and I think that's just going to continue. The only thing I would caution you is that money, although I would love it to go into the real economy, I don't see that happening. That's not going to go to CapEx. That's going to go to more financial engineering. That means more buybacks.
Yeah, well, we'll see. You have anything to add in this segment? Or are you spent? Because this was the Kevin Muir rant session.
It was a little bit.
Are
of
you
Kevin
done?
Muir rant.
Are you?
Well, how
are
about
you
this?
done ranting?
Why don't you tell me what you think's going to happen, Patrick?
Well, I'm not short bond. Well, actually, I'm short corporates, but I'm not, and I'm flat on treasuries, and I certainly subscribe to the view that there's room for the S&P to give the shorts a little bit of a squeeze. But I don't think I've changed my views too much from the bigger picture of the other things that I'm looking at. So, I mean, we cover
Still
those
think
things.
that you're in the Raoul Paul. You're a Raoul Paul bond bull, just not right now.
Well, you know what? I just believe that that the catalyst for like an inflationary catalyst, like you believe will happen, the risk of it eventually happening over time is there. I just think you're way too early, and I don't think that that inflation monster is an immediate fear. But maybe I'll be wrong. Maybe,
Okay,
and
so here,
that'll be-
Patrick, I have a question for you. Do they do one last squeeze of the shorts to really make me doubt myself?
on the
Do
bonds.
they? Yeah. Do they
No,
push it one?
the market is very capable of that. There's
for sure.
there's no
Yeah.
topping formation yet that you can confirm, which basically means one more squeeze higher is 100% on the table. Like I'm not saying it will happen, but you certainly can't rule it out anymore. There's not like a topping formation that is already reversed, right?
Right.
And therefore,
one
it's
thing
on the
I will
table.
tell you and warn people about is if we do get a situation where we get this massive run higher from here, you have to remember that increased volatility is often the sign of a top, not a bottom. Not of a continuation.
Okay.
So I'm prepared for, another move down into new highs.
Right.
That seems to suck everybody in, and then that's the prairie dog that you got to sell.
Right. Right.
Noble
All right.
animal.
Noble animal. All right. Let's go on.